following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today. We're on the airwaves at 94.1 FM WNBU as well as on Cable TV 10 in New Bern. We thank all our viewers and listeners for joining us. We've got a great show planned for you today. As always, a lot of the ideas for our show come from you, our viewers and listeners. So if you've got topics or comments or questions or anything you'd like to address on the show, by all means, reach out and give us a call or email. Our phone number is 252-633-0107. Our email is allthingsmoney@dlblain.com. And also feel free to visit us on the web, www.dlblain.com. There you'll find information about myself, my firm, as well as archived copies of the show. So now that we've got the introduction out of the way, let's move right into the show. Of course, the last few months have been very volatile in the financial markets. Stock markets all around the world have been going up and down. Kind of interesting, we had some scary moments there in August, but the investors that followed our advice and didn't panic didn't suffer that much of a decline. The markets are down somewhere around maybe 11 to 15%, depending on what you look at from their peak, which coincidentally is about the same decline that we suffered last year. And if you go back in history, once again, this decline we're currently experiencing is nothing out of the ordinary. It's part of the normal gyrations of the stock market. If you're new to investing, it can be somewhat frightening sometimes. Even if you're old to investing, sometimes there's just too much information out there. You know, people are watching CNBC, they're reading the Wall Street Journal, they're talking to their neighbor, they're talking to the people at work, and they're getting too much information and they're getting very confused. And so part of today's show we want to focus on is looking at what you can count on, looking at what you should be focusing on. There are certain truths and principles in investing that we feel like are going to continue as we go forward, that certain things on a short-term basis come and go, but certain truths in investing remain, and that is that over time you will receive some rate of return for the risk that you take by investing your capital, and that's what stock market is. You're investing capital in an enterprise that may or may not succeed, and for the risk that you're taking, you need to be compensated for that risk, something above what is considered the risk-free rate. And that's a very basic concept that if you believe in the underpinnings of capitalism, well, even if you don't, I mean, in China, people are becoming very wealthy over there, even under the sort of state-sponsored form of capitalism. Unfortunately, it's not available to everybody, and they kind of determine who is the winner and loser. But the point is that the investment of capital and the venturing and the taking of risk throughout history has been rewarded with some sort of return as well as loss. All the way back to the South Sea Company of Christopher Columbus, who discovered America. Of course, that was financed, and they had stock even way back then. And when ships were lost, people lost everything. But when ships made it to the new lands, whether they be America or China or whatever, and returned with goods from those lands and were sold in Europe, the stockholders of those companies made a profit. So the nature of the stock market has been around forever, and it's nothing new, and I don't anticipate that will go away anytime soon. Of course, we believe in diversifying. You don't want to invest all your money into the at one particular ship. It would be better if you invested your money across 10 or 15 ships back in the 1500s making their way to China. Well, we believe kind of the same way. unless you're the captain of that ship or have some sort of insider knowledge, we think that diversifying across different economies, different asset classes, different types of companies, different types of investment, commodities, real estate, things like that, that over time you'll be better served than trying to pick the one ship that will make a successful journey to China. And that's a great example. I just sort of thought of that off the top of my head right now, but that is a great example of comparing the investor of years ago investing all their money into one ship to make that perilous journey to either the New World or to China. Is a great analogy to today. Instead of going out there and trying to pick the one company that's going to be the next Apple, well, why not invest in trade in general to the New World, to continue this analogy? Why not have a small portion of every ship that went to China or every ship that went to the new lands? And I would venture to say that on average the returns for people that did that were much better than the people that put it all into one ship. Now certainly if that one ship made it all the way to China and came back with fine silk and teas and things like that, you certainly made more profit on that one, but you didn't have as much concern about losing all your money if you spread your investment amongst the different ships. The same thing today. Instead of trying to focus on picking that one company that's going to be the next Microsoft or Apple or Google or something, we recommend spreading your money amongst various companies. And on average, you in the end will come out much better. Now, if you have some specialized knowledge or something like that, and you go out and start your own company where you have much more control than the public markets, that's a whole different type of investing. That's a different story. But when you're talking about investing in the public markets, on average, there are certainly people that make out better. I know myself personally in my firm and investing, the late 90s, we did very well in a number of companies, the Microsoft, the Cisco, the Dells, the Enrons, things like that. But the key was we sold out of them before they declined. Now, as the markets have progressed over the years, we think that it becomes much more difficult the past decade to do that. And so we advocate that on average, the average investor will do much better diversifying their money across different asset classes. And the whole world has really opened up. I mean, the tech boom of the 90s was certainly global in nature, but it was still a lot happening in the U.S. that was not overseas. And in the past 10, 15 years, we've become a much more global economy. And frankly, most people just don't have the expertise to analyze, a bunch of Chinese companies or a bunch of Brazilian companies, that you're better off diversifying your bets. Well, believe it or not, we've come to the end of our first segment already. We've got to take a short break, a few messages from our sponsor. When we come back, we'll pick up with this theme of long-term investing, as well as work in a little bit about President Obama's new jobs bill. So for All Things Money, I'm David Blain.